What if you could supercharge your investments without using your own cash? Sounds a little risky, right? Well, borrowing to invest is a strategy some of the wealthiest people used and continue to use to build empires. So today I'm breaking down how to borrow money to invest safely and intelligently. So stick around because this could change your financial game. Hey everyone, welcome back to the channel. And if you're new here, I'm Patrick. I've been an investor for over a decade, an options trader, and a crypto investor for over 7 years. And I have grown my portfolio to over $250,000, and I run Apex Wealth Collective, a school community for investors where you can follow my portfolio journey and experience it with me firsthand. So today we're tackling a spicy topic, borrowing money to invest. Whether you're eyeing stocks, real estate, or even crypto, leveraging debt can amplify your returns, but it can also amplify your risks. And we are going to walk through the methods that you can use, which of these methods I personally have used, and interest rates that I have paid personally to give you a sense of what kind of interest rates you'll be paying. And finally, the golden rules I live by to avoid a financial faceplant with borrowing money. Now remember, I'm not a financial advisor. I'm just sharing what has worked for me and some of the successful people I look up to. But before we do, make sure you give this video a thumbs up and subscribe to the channel. So first, let's define borrowing to invest. It's exactly what it sounds like. You take out a loan or you use credit to buy assets, whether that's stocks, real estate, businesses, crypto, etc. You borrow money to invest in assets you expect to grow in value or generate income over time. This is called leverage, and it's like having a financial superpower. So for example, if you borrow $10,000 from the bank to buy a stock that grows 10%, you've made $1,000 on money you didn't have before. Minus, of course, interests and taxes. Now the catch, well, if the investment tanks, you still owe that money. You still owe that debt. This is why billionaires like Warren Buffett or Elon Musk use leverage strategically, but beginners need to tread carefully because it can lead to financial ruin if you do it incorrectly. But why do we borrow money to invest? Well, if you know anything about government-backed fiat currencies, you'll know that empires and superpowers have come and gone over thousands of years, and every single one of those empires had a once strong currency that inevitably failed. And today, with the US dollar being the powerhouse of fiat currencies around the world, it will too one day meet its demise, as will all the other currencies like the Canadian dollar, the Mexican peso, the bolivar, the euro, the yen, etc., etc. We invest our hard-earned dollars because the government inflates away our purchasing power day by day, week by week, month by month, year by year. It's like clockwork. So why would we not take advantage of weakening currencies, borrow them, and invest them into hard assets that appreciate over time? If fiat currencies do nothing but inflate and devalue over time, you do not want to hold it. You want to invest and use every dollar you can so that your future self isn't worse off. Fiat currencies are not good money. They are debt. It is important to understand how government-backed currencies work, because if you don't, you stand to lose the purchasing power of every dollar you work so hard to earn. Now, in the context of borrowing capital to invest, we will be specifically talking about investing in stocks and crypto because that is what I have used debt for to grow my own portfolio to 6 figures. So it is what I am most familiar with. So let's get into it. Here are the 4 ways in which you can borrow money to invest. Number 1, unsecured personal loans or personal lines of credit. Now you can take out a personal loan or a personal line of credit from a bank or online lender without collateral. These typically have higher interest rates, around 6 to 12% as of 2025, depending on your credit score and the current interest rates from the central banks. Now, personal loans are easy to get if you have good credit and have low amounts of debt, and you can use the funds for almost any investment. Not to mention, since the loan is not tied to any collateral, there's no chance of a margin call on your invested loan. However, be careful with the interest rates as they are typically variable rate and they're higher interest rates than other investment products or loan products. And so they can change with central bank policy rates. Now, this is the first type of loan I started with when I began building my current portfolio 5 years ago, and which I currently still use. Only borrow as much as you can easily repay the interests on every month, and expect the interest rates to fluctuate with interest rate change. Number 2, HELOCs, or home equity lines of credit. If you own a home A home equity loan or line of credit lets you borrow money against your home's value, often at lower rates, like 3 to 6%. This is probably the route for cheapest borrowing costs in flexible terms, but the downside is that your house is used as collateral here. So if you can't repay the loan or you miss several payments, you could potentially lose your house. Now, I've seen it happen many times, especially with the recent real estate bubble here in Canada. Borrow an amount that you can easily pay the monthly interest on from your day job. Don't go overboard. I've personally never used a HELOC, as I don't own a house, since housing is an asset reserved for the 0.1% in Canada. But it's a great product if you do own a house. And number 3, margin loans or security-backed lines of credit. And margin loans or SB locks, security-backed lines of credit, let you borrow from your brokerage to buy stocks, ETFs, or other securities. Rates here can also be low, around 4 to 8%, but brokers require you to keep a minimum balance. The great thing about this method is that it is quick access to funds without needing to sell assets, and no need to fill out lengthy paperwork at a bank or get a credit check to access. The problem with this method is that your portfolio is your collateral. So if your investments drop too much in value and you borrow too much cash against that portfolio, you'll face a margin call, forcing you to sell assets in your portfolio or add cash to the account to get back to the minimum balance under very short notice, most times within 24 hours or even by market close that same day in some cases. And I currently use this method as well and have borrowed approximately $30,000 against my stock portfolio, which I will dive into in another video coming soon. And lastly, credit cards. I don't even know why I'm including this as one of the options, because I would never choose this option, regardless of my situation, and I would never recommend it to anyone. The interest rates are too high, anywhere from 21 to as high as 30%. No matter what your credit score is, and it can put you into a deep hole if your investment thesis doesn't pan out. You can't borrow much with a credit card because the interest rates to pay back every month stacks up very quickly. And the last thing you need to be doing is to start compounding high interest on top of more interest. Now that we've gone over the different accessible ways to borrow money for investing, how do we limit liability and risk with borrowing money? Well, here's 5 quick tips that I personally use to stay safe and conservative with investing with borrowed money. And number 1, only borrow what you can afford to lose. Never borrow more than you can repay, even if your investment goes to zero. So calculate your monthly budget and stick to it. Target an amount where the minimum monthly payment on the loan is easily payable with your disposable income from your job. And number 2, invest in stable assets. Stick to diversified assets like indexes, or if you want a little more risk, blue chip cryptos like Bitcoin, Ethereum, or Solana. Not super speculative bets like meme stocks or brand new altcoins or penny stocks. Stability reduces your risk. And number 3, keep interest rates low. Your investment's return should beat the loan's annual interest rate. I will not take a loan for more than 10%. If you're paying 10% interest, aim for assets with consistent returns above that. In this case, if your interest rate is 10%, the only assets beating this interest rate is tech indexes like the NASDAQ, crypto, leverage index funds, and some leveraged covered call funds. And number 4, have a repayment plan. Now this one kind of ties in with the first tip, where you borrow only as much as you can afford to lose. Map out how you'll repay the loan. Don't just think or say that you're going to repay the loan. Actually create a plan and map it out. Don't rely on the investment returns alone to repay that loan, because if your investment goes to zero, you've got no plan to repay. And number 5, understand the risks. Markets crash, rates rise, rates lower, and plans fail. Always have an exit strategy, like paying down the loan with income or cutting losses early. In terms of using these ways to invest with borrowed money, I personally use, like I've talked about, the unsecured personal lines of credit, and I've used the margin loans or the security-backed lines of credit. Now for the personal lines of credit, I've used interest rates of 8 to 10%. And in terms of the margin loans or the security-backed lines of credit, I get like a decent interest rate here in Canada of about 4.5%. So depending on your brokerage, depending on the amount you're investing, the size of your portfolio, credit score, all that stuff can determine what your interest rates will look like with these different products. And so every person's going to be different, but those are kind of the ballpark numbers you can expect with these products. And that's the rundown for borrowing to invest. It's a powerful tool. It really is, but it's not a get rich quick scheme. If you're interested, start small, do your research, and always talk to a financial advisor. Now, what do you guys think? Have you ever borrowed to invest? I want to know. Or is it too risky for you? Drop your thoughts down in the comments and let's keep the conversation going. I read all comments. Now, if you've stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here where you can get a look at all the other content I have to offer about investing and my personal investing journey. Now, that's all for me today. I'm Patrick with Apex Wealth Collective. Take care, and I'll see you in the next video.